Hi, I'm Ronnie. I run strategy and trading at Veloris Capital, and today I want to explain why we own Western Digital. The short version is simple. Artificial intelligence creates enormous amounts of data, and all of that data needs somewhere cheap to live. Hard drives are still the lowest cost way to store information at scale. For years, investors treated the hard drive as a dying product. That view has now reversed. In February 2025, Western Digital split into two companies. The flash memory business became SanDisk, the kind of chips inside phones and laptops. Western Digital kept the hard drive business. We hold both as separate positions. Today's story is about the hard drives. The chart shows the stock over recent months, with the dashed gold line marking our average entry near $543. So, what does this business actually do? A hard drive stores data on spinning magnetic disks. It is slower than flash memory, but far cheaper for every terabyte you keep. Data centers use it for the warm middle layer of storage. That is the data they keep and reach now and then, rather than every second. Engineers call this the nearline tier, and hard drives dominate it. Here is the part our process likes most. Building these drives at scale is very hard to enter. Only two companies make the high-capacity versions, Western Digital and Seagate, with Toshiba a smaller third. When two careful makers control supply, prices tend to hold up better. Western Digital also keeps packing more data onto each disk, with its newest drives reaching around 32 terabytes. Higher capacity per drive is the main way it grows profit. Now the numbers, because we are data-driven, not gut-driven. In the most recent quarter, revenue grew about 45% from a year earlier. Gross margin reached about 50%, up roughly 10 percentage points. Operating margin runs near 37% over the last 12 months. For a company once seen as a low-margin hardware maker, that is a clear step up. Free cash flow over the last 12 months was about $2.9 billion on operating cash flow near $3.3 billion. The balance sheet has improved too. Western Digital now holds about $1.5 billion more cash than debt. That extra cash lowers financial risk if the cycle turns. The chart tracks revenue and the margin improvement quarter by quarter since the February 2025 split. Two more things matter to us. First, the direction of earnings forecasts. Analysts expect earnings near $9.94 a share this fiscal year, then about $18 next year. These are estimates, and estimates can move in either direction. What counts for us is which way they are moving. Over the past 90 days, the average forecast for next year rose from about $13.58 to about $18.05 a share. In the last 30 days, three of the roughly 19 analysts raised their number and none cut it. Rising forecasts with no downgrades are a signal our screen looks for. Now the honest part. The stock is expensive. It trades near $733, about 39 times next year's expected earnings, and it has risen more than tenfold in a year. A high multiple adds risk if growth slows. We hold the position with that risk in full view. So, how did Western Digital earn its place? We do not buy a stock because of a good story. Every candidate runs through three pillars: stock universe, optimizer, and risk overlay. The stock universe filter screens for real growth, healthy margins, a sound balance sheet, and rising earnings forecasts. Western Digital cleared each one. The optimizer decides which qualified names to hold, not how big each position should be, because all of our positions are equal weighted. It picked Western Digital for exposure to the storage layer of the AI build-out. Then the risk overlay. Every night, the system recalculates more than 20 risk indicators across markets and sets our equity exposure for the next day. Western Digital swings about twice as much as the market, so this matters. The overlay is not a prediction machine. It is time-tested to limit losses in a deep downturn, not to forecast prices. That is why Western Digital sits in the portfolio, a real growth story, an industry with only two serious makers at scale, improving margins, and the cycle risk fully acknowledged. If you want the detail, read the full deep dive in our cockpit or join our weekly newsletter, the Pit Lane Briefing. And if you choose to copy us on eToro, your account simply mirrors our trades proportionally. You stay in control of your own account at all times. Thanks for watching. One last note. Past performance is not an indication of future results. Your capital is at risk.